The stock market has its own language, and if you don't speak it, you'll lose money. In the next 13 minutes, I'll teach you every single term you need to know. Let's go. Stock. A stock represents ownership in a company. When you buy stock, you own a piece of that business. Share. Each unit of stock is referred to as a share. One share equals one tiny slice of ownership. Shareholder. That's you, someone who owns shares of a company's stock. Public company. A company whose shares can be bought and sold by anyone on a stock exchange. Think Apple, Tesla, Amazon. Private company. A company whose shares aren't available to the public. You can't just buy them on an app. Stock exchange. The marketplace where stocks are bought and sold. The New York Stock Exchange and NASDAQ are the big ones. Ticker symbol. The abbreviation used to identify a stock. Apple is AAPL, Tesla is TSLA. It's like a stock's nickname. IPO, initial public offering. When a private company goes public and sells shares to investors for the first time, it raises significant capital. Market cap, market capitalization. A company's total value is determined by its stock price. It's calculated by multiplying the share price by the total number of shares. Blue chip stocks. Stocks from large, established, reliable companies with a history of stable performance. Think Coca-Cola, Johnson & Johnson. Boring but dependable. Penny stocks. Stocks that trade for less than $5 per share. High risk, high potential reward, high chance you lose everything. Volume. The number of shares traded during a specific time period. High volume means lots of action. Liquidity. How easily can you buy or sell a stock without affecting its price? High volume equals high liquidity. Dividend. A portion of a company's profit is paid out to shareholders. Not every company pays dividends, but when they do, it's basically free money for holding the stock. Bull market. When stock prices are rising. Named after how a bull attacks, thrusting upward. Bear market. When stock prices are falling. Named after how a bear attacks, swiping downward. Volatility. How much and how fast a stock's price moves up and down. High volatility means wild swings. Low volatility means stability. Bubble. When stock prices rise well above their intrinsic value due to hype and speculation, eventually bubbles pop. And when they do, prices crash. Crash. A sudden, severe drop in stock prices across the market. Think of the 2008 financial crisis or Black Monday in 1987. Correction. A drop of 10% or more from recent highs. It's basically the market saying, okay, maybe we got a little ahead of ourselves. Rally. A period of sustained price increases. The opposite of a crash. Index. A way to measure the performance of a group of stocks. The S&P 500 tracks the 500 largest U.S. companies. The Dow tracks 30 major companies. Inflation. When the cost of goods and services rises, your money loses purchasing power. Stocks can be a hedge against inflation. Recession. When the economy shrinks for 2 consecutive quarters, stock prices usually fall during recessions. Broker. The platform or person that executes your stock trades. Robinhood, Fidelity, Charles Schwab, these are brokers. Brokerage account. The account you use to buy and sell stocks. You need one to invest. Market order. An order to buy or sell a stock immediately at the current market price. Fast execution, but you don't control the exact cost. Limit order. An order to buy or sell a stock at a specific price or better. You set the price, but there's no guarantee it'll execute. Stop-loss order. An order that automatically sells your stock when it hits a certain price. It's designed to limit your losses. Day order. An order that expires at the end of the trading day if it isn't filled. Good till canceled order. GTC. An order that stays active until you cancel it or it gets filled. Bid. The highest price a buyer is willing to pay for a stock. Ask. The lowest price a seller is willing to accept. Bid-ask spread. The difference between the bid and ask price. A smaller spread usually means better liquidity. Going long. Buying a stock with the expectation that its price will rise so you can sell it later for a profit. Shorting. Short selling. Borrowing shares and selling them. Hoping the price drops so you can repurchase them cheaper and pocket the difference. Risky because losses can be unlimited. Short squeeze. When a heavily shorted stock's price skyrockets, forcing short sellers to buy back shares at higher prices, it pushes the price even higher. GameStop 2021 is the classic example. Portfolio. the collection of all your investments, stocks, bonds, ETFs, whatever you own. Asset, anything you own that has value. Stocks are assets. So is real estate, gold, or even your car. Security, a tradable financial asset like a stock or bond. Bond, a loan you give to a company or government. In return, they pay you interest over time. Bonds are generally safer than stocks but offer lower returns. ETF, exchange traded fund, a basket of stocks or other assets that trades like a single stock. You buy one share of an ETF and you own a piece of hundreds of companies. Index fund, a type of ETF or mutual fund designed to track a specific index like the S&P 500. Low fees, broad diversification, long-term growth. Mutual fund, a pool of money from many investors that a professional manages. They pick the stocks, you pay them a fee. Hedge fund, an investment fund for wealthy people that uses risky strategies to try to beat the market. High fees, high risk, high barriers to entry. 401k, a retirement account offered by your employer. You contribute pre-tax money and it grows tax-deferred until you retire. IRA, individual retirement account, a personal retirement account with tax advantages. A traditional IRA gives you a tax break now. A Roth IRA lets you withdraw funds tax-free later. Roth IRA, you pay taxes on the money now, but your investments grow tax-free, and you don't pay taxes when you withdraw in retirement. Capital, money or assets are used to invest or build wealth. Capital gains, the profit you make when you sell an asset for more than you paid for it. Capital gains tax, the tax you pay on your investment profits. Short-term gains, held for less than a year, are taxed at a higher rate than long-term gains. Fundamental analysis, evaluating a stock based on the company's financial health, earnings, management, industry position, and economic conditions. Technical analysis, using charts, patterns, and statistical indicators to predict future price movements based on past data. E ratio, price to earnings ratio, a stock's price divided by its earnings per share. It tells you how much you're paying for every dollar of profit. High PE might mean overvalued. Low PE might mean undervalued or just unloved. EPS, earnings per share. A company's profit is divided by its number of shares. It shows how much money the company makes per share. Yield, the return on your investment is usually expressed as a percentage. For dividend stocks, it's the annual dividend divided by the stock price. Book value, the value of a company is based on its balance sheet. Assets minus liabilities. It's what the company is theoretically worth if you sold everything and paid all debts. Intrinsic value, what an analyst believes a stock is actually worth based on projected future earnings and growth. Often different from the market price. Price to book ratio, the stock price is divided by the book value per share. Helps determine if a stock is over or undervalued. Market sentiment, the overall attitude of investors toward the market or a particular stock. Bullish sentiment means optimism. Bearish sentiment means pessimism. Options, contracts that give you the right but not the obligation to buy or sell a stock at a set price by a specific date. Call option, the right to buy a stock at a specific price. You profit if the stock price goes up. Put option, the right to sell a stock at a specific price. You profit if the stock price goes down. Futures, contracts that obligate you to buy or sell an asset at a predetermined price on a specific date. No backing out. Leverage, using borrowed money to invest. It can amplify gains but also amplify losses. Margin, money you borrow from your broker to buy stocks. Margin trading is risky. You can lose more than you invested. Diversification, spreading your investments across different assets to reduce risk. Don't put all your eggs in one basket. Dollar cost averaging, investing a fixed amount of money at regular intervals, regardless of the stock price. It reduces the impact of volatility. Rebalancing, adjusting your portfolio back to your target allocation. If stocks have grown too much, you sell some and buy bonds to maintain balance. Compound interest, earning interest on your interest. It's the secret sauce of long-term wealth building. Return on investment, ROI, the percentage gain or loss on your investment. If you invest $1,000 and it grows to $200, your ROI is 20% to the moon. When a stock's price is skyrocketing fast, this stock is going to the moon. Tanking, the opposite. The stock is crashing hard and fast. Pump and dump. A scam where fraudsters hype up a stock to drive the price up, then sell their shares at the peak, leaving everyone else with losses. Rug pull. Similar to pump and dump, but usually in crypto. The creators abandon the project and run off with investors' money. Diamond hands. Holding onto a stock no matter what, even during a crash. You're not selling. Paper hands. Selling at the first sign of trouble. Weak hands. Bag holder. Someone is stuck holding a stock that's tanked in value. You bought high, it went low, and now you're having the bag. FOMO. Fear of missing out. Buying a stock just because everyone else is and you don't want to miss the gains. Usually a bad idea. FUD. Fear, uncertainty, and doubt. Negative news or rumors spread to drive down a stock's price. Whale. An investor or institution with so much money that their trades can move the market. Dead cat bounce. A temporary recovery in a stock's price during a downtrend, followed by more decline. Even a dead cat bounces if it falls from high enough. Unicorn. A startup valued at $1 billion or more. Black Swan. A completely unexpected event that has a massive impact on the market. COVID-19 was a black swan event. There you go, 85 plus stock market terms in under 14 minutes. You now speak the language. If this helped you, hit that subscribe button. Drop a comment with the term that surprised you most. And if you want me to explain any of these in detail, let me know. Next video, we're debunking every financial myth you've been told. See you there.